Well, there definitely are winners and losers from lower interest rates, and unfortunately savers are the ones bearing the brunt of lower rates. One of the more common questions I get at the moment from clients is how can I earn more than the 2% that the bank is offering on my term deposit, or even less. So unfortunately, the outlook is for further interest rate cuts from here. Term deposit rates are likely to go even lower. The Reserve Bank cut the official cash rate to 0.75% at the October meeting, and the market's pricing in further cuts to the cash rate from here. So that'll feed into lower term deposit rates, and I guess the issue for a lot of people is they're probably already earning a negative return after tax, after inflation on a term deposit. So yes, term deposits provide a very safe investment, and that the safety of a term deposit is enhanced by the government guarantee of $250,000 per account. But that safety comes at a very high cost, given that a lot of investors probably are going backwards once we take inflation and tax into account. I guess the question is, what else? How should I respond in the face of lower interest rates? And the approach we take is to encourage investors to think about their time frame, because if you can take longer than a 12-month view, then there are other options out there for you. Term deposits are very well suited for a short-term purpose, but if you can take that longer-term view, then you can take some additional risk, and that can allow you to earn a higher return. That doesn't necessarily involve investing into the share market. There are other options out there to consider, and if we take, say, a bank, for example, and think about the bank capital structure. At one end, we've got term deposits, and then that ranges all the way through down to, say, hybrids and bank shares at the other end. And a whole range of different securities, different debt securities in between, with different levels of priority and different levels of security. So we can invest into some of those bank debt securities to get a higher return than term deposits. Yes, there's some additional risk, but it's much less risk than, say, investing into the share market. So you can access those bank securities directly, or you could use a managed fund, an ETF, which is going to give you a much better range of diversification than you would, say, investing directly. In summary, I think the best approach for dealing with lower interest rates is to have a look at your investment time frame. If you can take a longer term view, then arguably you can take some additional risk to earn a higher return that doesn't necessarily involve investing into the share market.